Hi, I'm Professor Bei Dong from USF School of Accountancy. Today we're going to cover some topics related with current liabilities and contingencies. In this audio, we're going to briefly discuss presentation and analysis of current liability. When we present these current liabilities on the balance sheet, this section will be listed before long-term liabilities, and items in this section will be listed in the order of due dates, which means that the closer the due dates of the specific current liability items, the earlier we're going to put this item in this section. And for each item, each current liability item, we're going to present them at their principal or face value, which means that we ignore the difference between the future values and the present values of any current liabilities because the difference is so immaterial. So, for example, if you borrow $30,000 from a bank and it's due within 3 months, so since this is a current liability, we directly put the $30,000, which is the amount you're going to pay off 3 months later, on your balance sheet. And we don't have to calculate the present value of those $30,000 today. Now, let's talk something related with the analysis of current liabilities. The biggest concern about current liabilities is that whether this firm can pay off those current liabilities when they are due, or can this firm pay their bills in the short run. So one of the indicators we could calculate is this net working capital. It equals current assets minus current liabilities. So of course we want this indicator to be positive. Positive net working capital means that this firm has more current asset to cover the current liabilities. So it is a measure of short-term liquidity. However, the shortcoming of using this indicator alone is that it is a raw number. It is a raw dollar value. It is very difficult to compare different firms' net working capital to assess their liquidity. So, to address the problem of net working capital we just talked about, in terms of the raw number, we can turn that net working capital into current ratio, which equals current asset divided by current liabilities. Current asset, current liabilities are the numbers you can find from any balance sheet. So current asset includes, for example, cash and cash equivalents, short-term investment, accounts receivable, inventory, and any other type of current asset. Okay, so this ratio mathematically means that we want to measure how much current asset a particular company has to cover every $1 of current liability. So this ratio measures solvency in the sense that current asset can be used to meet current liabilities. Of course, the higher the current ratio, the lower the risk. But it doesn't mean that everybody loves high current ratio. I would say that the short-term creditors prefer higher current ratio than the investors because they care more about risk, while the investors, they care more about long-term growth of this company. They do not want to see lots of the firm's assets stuck with this current asset. They want to use those assets and turn to profit in the future. The second ratio we're going to use to analyze current liabilities is quick ratio. Quick ratio is very similar to current ratio. Both ratios talk to current liabilities. Quick ratio equals cash plus marketable securities plus accounts receivable. The summation of these three items is called quick asset divided by current liability. So this ratio focuses on quick assets that are likely to be converted into cash within a relatively short time period. So this ratio will be smaller than the current ratio. This ratio is a more stringent test of the firm's capability to pay off current liabilities. We also call it asset test. And in this ratio, when we calculate the numerator, we kick out other current asset, for example, inventory, because we don't believe inventory is as liquid as those three items of quick assets. The third ratio we're going to talk about to analyze current liabilities is called cash flow from operation to current liabilities ratio. It equals cash flow from operations divided by current liabilities. Cash flow from operation, this is a number we can find from statement of cash flows. Current liabilities, usually we replace it with average current liabilities, which equals last year plus this year's current liabilities divided by 2. So this ratio measures how much operating cash flow this firm can generate to cover every $1 of current liabilities. That measures the ability of the firm to pay current liabilities without borrowing or additional investment. So in the importance and the difference between this ratio and quick ratio and current ratio exists in that this ratio focuses on the cash flow from operation generated from the insider of the firms. They differentiate between cash flow from operation and from other sources, for example, borrowing. So if you have some concern about to what extent your current asset or quick asset can be converted into cash and be used to pay off the current liabilities, this ratio can alleviate that concern because the numerator of this ratio is just a direct operating cash flow from this firm.